Do not adjust your screen. What you're seeing is real. The price of silver did not just rise today, it teleported. We are looking at a market that has moved $61 in a single trading session. We are trading at $78.83. That is a gain of 8.25% in one day. If you have been waiting for the signal, this is it. This is not a normal rally. Normal markets do not move 8% on a Tuesday morning. This is a liquidity vacuum. It is the sound of the paper market snapping under the pressure of the physical reality. For weeks, we have told you that the price in the West was too low. We told you that New York was trading at a discount to the world, and today the elastic band finally snapped. The United States price is frantically chasing the global price. But even after this massive explosion, we are still behind. We just received the data from the Shanghai Gold Exchange. While New York is celebrating at $78, China is trading at $83.98. There's still a $5 gap. The magnet is still pulling us higher. In this emergency market broadcast, we are going to dissect the anatomy of this vertical move. We're going to explain why the arbitrage bots are buying every single contract they can find to close the gap with China. We are going to look at the short squeeze that is liquidating the banks who tried to cap the price last week. And we are going to show you why $78 might still be the cheapest silver you will see for the rest of the year. The dam has burst, the water is rising, and the banks are drowning. This is the story of the $6 candle. To understand why silver moved $6 today, you have to understand the physics of a vacuum. In a liquid market, there are sellers at every price level. Someone sells at 73, someone sells at 74, someone sells at 75. The price has to chew through these orders to go up. It is slow. It is a grind. But today, there were no sellers. The ask side of the order book was empty. The banks who usually sell to cap the price, they stepped away. Why? Because they are terrified of the Shanghai price. They know that if they sell silver at $75 in New York, they're giving away free money to anyone who can ship it to China for $84. So the banks pulled their sell orders. And when the buyers stepped in, the pension funds, the industrial hedgers, they found an empty room. They hit market buy and the price skipped from 73 to 75 to 78. It met no resistance. This is what we call teleportation. It confirms that the float, the available inventory for trading, has vanished. We are now in a market where price has to jump massive distances just to find a single ounce of liquidity. This volatility is not a bug. It is a feature of a shortage. When you run out of physical buffer, price becomes the only shock absorber. Let's look at the target, $83.98. That is the price of silver in China right now. For the last week, we have watched New York lag behind. New York was at 72, China was at 80. New York was at 75, China was at 82. The market cannot sustain two different prices for the same asset forever. It violates the law of one price. Arbitrage traders, the most ruthless actors in the financial world, are forcing these two numbers to converge. They are buying the cheap New York contracts and selling the expensive Shanghai contracts. This buying pressure in New York is relentless. It does not care about technical indicators. It does not care if the RSI is overbought. It only cares about the spread. As long as New York is cheaper than Shanghai, the buying will continue. And right now, even at $78, New York is still $5 cheaper. This tells us that the rally is not over. The arbitrage vacuum is still open. The pressure is still equalizing. We are witnessing the US dollar price being dragged up by the UN price. The pricing power has shifted east, and the West has no choice but to follow. Now spare a thought for the short sellers. Imagine you're a hedge fund that shorted silver last week at $75, thinking it was a double top. You woke up this morning to a $6 loss on a standard futures contract. That is a loss of $30,000 per contract. If you held 100 contracts, you lost $3 million before you finished your coffee. This triggers a forced liquidation. The risk manager at the brokerage firm takes over the account. They do not ask the trader what to do. They just hit buy. They buy at 76, they buy at 77, they buy at 78, and they are priced inelastic. They just need to exit. This short covering acts as rocket fuel. It is panic buying, and it is hitting a market that has no sellers. This creates a feedback loop. The higher the price goes, the more shorts get liquidated. The more shorts get liquidated, the higher the price goes. We are in the middle of a gamma squeeze and a short squeeze simultaneously. It is a perfect storm of financial pain for the bears. You might think that at $78 the physical market would loosen up. You might think dealers would lower their premiums, but they aren't. We are checking the dealer feeds right now. The premiums are holding steady or rising. Why? Because the dealers see the Shanghai price too. They know that $78 is still a discount. They're not going to sell you a Silver Eagle for $80 when they know it cost $85 to replace it in the global market. So, The physical lockout continues. This confirms that the rally is real. If this was a fake paper rally, the physical price would lag. But the physical price is leading. The street price is validating the screen price. We are not seeing a bubble. We are seeing a re-rating. The market is realizing that $70 was simply the wrong price for a scarce strategic asset. Finally, look at the volume. Today's move wasn't on thin air. It was on massive institutional volume. Billions of dollars changed hands today. This tells us that the big money is participating. This isn't just a few retail traders chasing a chart. This is pension funds. This is banks. This is industry. When price rises on high volume, it is a sign of conviction. The buyers are committed. They are stepping in at 76, 77, 78. They're building a new floor. The wall of worry has been climbed. Now we are running on the plateau. So the vacuum is open. The shorts are dead. The East is leading, but silver is not alone in this move. There's another signal flashing red on the dashboard. A signal that tells us this isn't just about silver supply. It is about the stability of the global financial system. Gold just made a move that is statistically rarer than the silver spike. Gold is up 135 hours, 3% in a day. For the world's largest reserve asset, that is an earthquake. In the next section of this broadcast, we are going to analyze the gold signal. We are going to explain why a 3% move in gold confirms a systemic event. We are going to look at the debt markets and the geopolitical triggers that are driving capital into safety. And we are going to explain why silver is acting as gold on steroids. The king has moved, the knight is following. We are watching the checkmate of the fiat currency system. We need to take our eyes off the silver chart for a moment and look at the bigger picture. Because what happened to gold today is statistically more significant than what happened to silver. Silver is volatile. It moves 8% regularly. But gold is the bedrock of the global financial system. It is a $15 trillion asset class. It moves like a glacier until today. Look at the gold price. It is trading at 4,167. It is up $135 in a single session. That is a move of over 3%. To put that in perspective, a 3% move in gold is the equivalent of the Dow Jones moving 1,500 points in a day. It is a black swan event. It does not happen during normal trading. It happens during the invasion of Ukraine. It happens during the collapse of Silicon Valley Bank. It happens during the financial crisis of 2008 when gold moves 3%. It is the market screaming that something in the financial system has broken. It is a systemic distress signal. The smart money, the central banks, the sovereign wealth funds, they are fleeing the dollar, they are fleeing the bond market, and they are piling into the only asset with no counterparty risk. This validates the silver rally. Silver is not going up because of a Reddit squeeze. It is going up because the entire monetary order is being repriced. Silver is simply drafting behind the king. And when the king runs, the prince sprints. This brings us to the concept of high beta. In finance, beta measures how much an asset moves relative to a benchmark. Silver is historically gold on steroids. It has a beta of roughly 2 or 3 against gold. If gold goes up 1%, silver goes up 2 or 3%. Today gold went up 3%, silver went up 8%. The math holds perfectly. This is exactly how a healthy precious metals bull market is supposed to behave. This correlation is your safety net. If silver was up 8%, but gold was flat, I would tell you to be careful. That would look like a speculative bubble. But because gold is leading the charge with a historic move, silver's move is justified. It is foundational. The world is repricing hard assets against fiat currency. Gold is doing the heavy lifting. Silver is just benefiting from the overflow. The overflow of capital fleeing the dollar is too big for the gold market to hold. So it spills into silver. And because the silver market is tiny, that spillover creates a tsunami. We have to ask the question, why today? Why did gold rip $135 on a Tuesday in January? We know about the Venezuelan news, but usually geopolitical news spikes the price for an hour, and then it fades. This rally didn't fade. It accelerated into the close. This suggests that the geopolitical risk is morphing into a financial risk. The market is sniffing out a problem in the bond market or a problem in the banking system. When gold rises this fast, it usually means that a major institution is in trouble or a major currency is about to devalue. We are seeing insider buying. Someone knows something that hasn't hit the headlines yet. Maybe a central bank is about to dump treasuries. Maybe the war in South America is about to expand. We don't know the specific headline yet, but the price is the news. The price tells us that safety is suddenly in very high demand, and silver is the poor man's safe haven. When gold gets too expensive for the average investor, they turn to silver. At $4,400, gold is becoming out of reach for retail. At $78, silver still looks affordable. This substitution effect drives silver higher as gold becomes a luxury asset. Let's look at the gold to silver ratio. At the start of the week, it was near 60. Today, with gold at 4,467 and silver at 78.883, the ratio has dropped to roughly 56. We are compressing. This means silver is outperforming gold. Historically, during the mania phase of a bull market, this ratio collapses. It goes to 40, then 30, then 15. We are still at 56. This tells us that despite the 8% rally, silver is still undervalued relative to gold. It has not even reached its historical average valuation yet. If the ratio returns to the 2011 lows of 32:1 and gold stays right here, silver would be $148. This is why the algorithms keep buying. They are playing the ratio trade. They sell expensive gold and buy cheap silver to close the gap. As long as gold remains strong, the floor under silver rises mathematically. Gold is the shield. Silver is the sword. We also have to look at the macro calendar. The U.S. debt ceiling deadline is approaching in Q1. The Treasury is running out of cash. The bond market is getting nervous. A 3% move in gold is often a vote of no confidence and the government's ability to pay its bills without printing money. The market is pricing in fiscal dominance. This is the economic theory that says the central bank is forced to print money to fund the government. When fiscal dominance kicks in, fiat currency loses value rapidly. Hard assets re-rate to infinity against the dying currency. We are watching the market realize that the debt spiral is terminal. There is no way out except inflation. And if you know inflation is coming, you buy gold, you buy silver, and you buy them now at any price. That is the panic we saw today. It wasn't speculation. It was an exodus from the dollar. So the monetary system is shaking. Gold is flying. The banks are covering. But what about the factories? What about the people who actually need silver to build products? In part 3, we are going to pivot back to the real economy. We are going to look at the industrial panic that this price spike is causing. If you are a solar panel manufacturer and the price of your raw material just went up 8% in a day, you are terrified. You are about to panic buy inventory before it goes up another 8% tomorrow. We are going to look at the inelastic demand curve, and we are going to look at the dealer market where premiums are rising despite the higher spot price, proving that the physical shortage is getting worse, not better. The paper price is high, but the physical metal is gone. Stay tuned for part 3. We are going to the supply chain. We have spent the last hour looking at the financial fireworks. We have watched the short sellers burn. We have watched gold scream, a warning to the central banks. But financial markets are just a reflection of the real world. And in the real world, on the factory floors of Korea, China, and the United States, a different kind of panic is setting in. It is one thing for a trader to miss a move on a chart. It costs him money. It is another thing for a factory manager to miss a shipment of silver. It cost him his business. Today, with silver exploding $6 in a single session, the global supply chain just had a heart attack. In part 3, we are going to leave the trading pits and go to the industrial front line. We are going to explain why companies like Samsung and Tesla are currently engaging in panic hoarding. We are going to break down the concept of inelastic demand, why the price of silver can go to $100, and the industry will actually buy more, not less. And we are going to look at the dealer freeze happening right now in the U.S. retail market. If you think it is hard to buy a contract on the COMEX, try buying a monster box of Eagles today. The paper price is $78. The physical price is sold out. Let's look at the shortage. I want you to imagine you are the chief procurement officer for a major solar panel manufacturer. Your factory produces millions of dollars of panels a day. To make those panels, you need silver paste. Silver makes up maybe 5% or 10% of your total cost. Yesterday, silver was $72. Today, it is $78. Does this price hike make you stop buying? No. Because if you stop buying silver, you can't finish the panel. If you can't finish the panel, you can't sell it. You lose 100% of the revenue because you tried to save 5% on the cost. This is called price inelasticity. The industrial buyer is not sensitive to the price. They are sensitive to the availability. When the price spikes $6 in a day, the procurement officer doesn't think it's too expensive. He thinks, oh no, there is a shortage. I need to buy more now before it runs out. So the price spike actually triggered more buying. We are seeing reports of industrial users doubling their orders. Today, they are switching from just-in-time delivery to just-in-case hoarding. They are draining the supply chain to build a buffer. This is the inventory supercycle, and it turns a price spike into a price spiral. Now let's look at the bullion dealers, the companies that sell silver to you and me. APMEX, SD Bullion, JM Bullion. Today was a nightmare for them. Imagine you were a dealer. You own 10,000 ounces of silver. You bought it for $70. Suddenly, the spot price rips to $78. You should be happy, right? You made a profit, but you have a problem. If you sell that silver to a customer today for $79, you have to replace it. But the wholesale market is chaotic. The refiners are raising prices. The Shanghai magnet is sucking up inventory. What if by the time you go to restock tomorrow, the price is 85? You just sold your inventory at a loss relative to the replacement cost. You sold gold to buy lead. So what do dealers do in a vertical market? They widen the spreads. They jack up the premiums. Spot is $78.83. But if you go to a website right now, the price for an eagle is likely $95 or higher, or they simply pull the inventory out of stock. Call for pricing. They are freezing sales to protect themselves from the volatility. This creates a physical lockout. The screen says silver is $78, but you cannot exchange your paper dollars for metal at that price. The real price, the price to get metal in your hand, is rapidly approaching $100. The paper market is lagging the physical reality by $20. We have to talk about the mining companies. At $78 an ounce, primary silver miners are printing cash flow that rivals the tech giants. Their costs are fixed. They pay for diesel, labor, and steel. Those costs didn't go up 8% today, but their revenue did. That entire $6 move flows straight to the bottom line. However, look at the mining stocks. Are they up 8%? Some are, but many are lagging. Why? Because the general stock market is nervous. The war news from Venezuela spooked the S&P 500. So generalist investors are selling everything, including miners. This creates a massive valuation gap. You have companies trading at 3 times earnings. You have companies with dividend yields that are about to explode. The market hasn't done the math yet. It hasn't realized that at $78, these aren't mining companies anymore. They are cash machines. This lag is the opportunity. Usually the metal moves first, then the stocks catch up. We are in the metal move phase. The stock catch-up phase usually happens a few days later when the analysts update their spreadsheets and realize their price targets are 50% too low. If you missed the move in silver, the miners are still on sale. Let's check back in on our favorite indicator, Shanghai. We started this video by saying Shanghai was at $84. New York rallied to 78.83 to catch up. Did we catch them? No. We closed the gap from $10 to $5. But $5 is still a massive arbitrage. It means the sucking sound is still there. Metal is still flowing east. The pressure has not been equalized. This tells us that $78 is not the top. If we were at the top, the price in New York would be higher than Shanghai. We would be overbought, but we are still underbought relative to the physical market in Asia. We are still the discount bin. As long as Shanghai leads, New York must follow. The physics of arbitrage demand it. So the industry is hoarding. The dealers are freezing, the miners are printing cash, and China is still paying more. Where does this end? We are approaching the blue sky zone. Above $80, there's no chart history, there's no resistance, there's only the psychology of the crowd. In part 4, the conclusion of this series, we are going to give you the endgame strategy. We are going to map out the targets for the rest of the week. We are going to discuss the psychological trap of selling too early. And we are going to leave you with the final verdict on whether this is a trade or a paradigm shift. The price is moving fast. Make sure your mind is moving faster. The final countdown to $80. We have reached the final chapter of this emergency broadcast. We have analyzed the $6 explosion that rocked the market this morning. We have looked at the gold signal screaming systemic risk. We have exposed the industrial panic that is draining the physical supply chain. Now, we are standing at $78.83s. We are breathing rarefied air. For the last decade, silver investors have been underwater fighting for every cent. Today, you are winning. And winning brings a new set of problems. The biggest problem you face right now is not the banks. It is not the Fed. It is vertigo. When you look at a vertical chart, your brain screams at you to sell. You can't go higher. This is a bubble. Take the money and run. In this final breakdown, part 4, I'm going to give you the psychological armor you need to survive the next leg of this rally. I'm going to explain why selling your silver for dollars right now is the most dangerous trade you can make. I'm going to map out the blue sky targets above $80, and I am going to leave you with the final verdict on whether this is the top or just the beginning. The ceiling is shattered. The sky is open. Let's finish this. Technically speaking, we are approaching a zone called blue sky. Above $80, there's no price history. There are no resistance lines. From 20 years ago, there are no bag holders waiting to sell to get their money back. Everyone who owns silver is in profit. When a market enters blue sky, the rules of gravity change. Price moves faster because there is no overhead supply. The only resistance is psychological. $100 is a wall because it is a round number, not because there are sellers there. This means we could see volatility expand even further. If we move $6 today, we could move $10 tomorrow. Do not be scared of the speed. Speed is what happens when a compressed spring is released in a vacuum. The market is trying to find a price that balances the books. And since the Shanghai price is $84, the books are not balanced yet. We have to go higher, just to reach equilibrium. Now let's talk about the urge to sell. You see the profits in your account, you want to lock them in. But lock them into what? Dollars. Think about why silver is rising. It is rising because the dollar is falling against real assets. It is rising because the debt is unpayable and war is breaking out. If you sell your silver at $78, you're trading a safe haven for a risk asset. You're trading the lifeboat for a ticket back onto the Titanic. The smart money does not sell for cash during a currency crisis. They swap. They trade one undervalued asset for another. They wait for the gold to silver ratio to tell them it is time to move. Right now, the ratio is 56. Historically, the ratio bottoms at 15. This means silver is still cheap relative to gold. It has room to double against gold. Even if gold doesn't move another inch, so do not sell for dollars. If you must sell, swap for gold. But even then, it is too early. The ratio says hold. We also have to consider the public. Today's move, 8% will be on the news tonight. It will be on social media. The average person is just waking up to the fact that silver is the asset of the year. They haven't bought yet. They are still opening their accounts. They are still driving to the coin shop. This means the retail wave is still ahead of us. The mania phase happens when the public goes all in. We are in the institutional phase. The institutions are buying. The public is watching. When the public starts buying, that is when we go from $80 to $150. You do not want to sell before the mania. You want to sell into the mania. You want to sell when your Uber driver gives you silver tips. We are not there yet. So here's the verdict on the Shanghai explosion. The market has broken. The West lost control of the price because they lost the physical metal. The East is setting the price because they have the demand. The arbitrage gap is forcing a revaluation of the entire precious metals complex. $78 is not a bubble. It is a correction to reality. The reality is that silver is scarce, strategic, and essential. The paper price was a lie for 40 years. Today the truth came out. Your strategy is simple. Sit tight. Ignore the volatility. Ignore the intraday swings. Focus on the Shanghai price. As long as China is paying more, the trend is up. Focus on the gold price. As long as gold is at all-time highs, the system is broken. You have positioned yourself correctly. You own the asset that the world needs. Do not let them shake you out. Do not let them trick you into selling early. The squeeze is live. The target is triple digits. And we are just getting started. Subscribe.